Students, in the last lecture, I told you about the international money market where the short-term instruments for less than 1 year are exchanged. And in today's class, I will be talking about the international credit market where both the medium and long-term funds are exchanged between the borrowers and lenders. Okay, so the international financial market segment where the medium term funds and long term funds are exchanged is the international credit market. Now when I talk about the medium term funds, they are generally issued by banks at floating rate of interest. What is floating rate of interest? It means the rate of interest keeps on changing based on some particular value, and generally this is based on LIBOR. What is LIBOR? LIBOR is London Interbank Rate. Okay, so it is a reference through based on which the interest rate on the loan changes periodically. Okay, now another important practice followed in the international credit market is called syndicated loan. See, sometimes giving a single loan by a single lender becomes very difficult, maybe because the loan amount is big or if the risks are small. So suppose you have to give a very big loan. What lenders can do that? One lender can give a small part, second lender can contribute, third lender can contribute. So in such a way in which jointly loan is distributed is called a syndicated loan. This is an important topic. Syndicated loan is when a group of banks under a lead bank will join together to disperse loan jointly. Okay, so why is it beneficial? Firstly, because if there is a huge amount, it is difficult for a single bank to give the loan, and secondly, it helps to reduce the risks associated with huge lending. Okay, now an important part of the international credit market is the bond market. What is a bond? See, a bond is a financial instrument which can be issued either by the government, be it local or government, or it can be issued by corporations. Okay, both governments and corporations can issue bonds. Now bond is a promissory note. It's a type of promissory note, and in this what will happen is the borrower who wants money, who will issued by borrower. So the borrower who wants to borrow money will issue a bond to the lender. Okay, and in return, so he will give a bond to the lender, and in return the lender will give money. So what benefit will the lender get? See, suppose a person has, a government or a corporation has issued bond today for 5 years. So they have taken, suppose 10 lakh rupees for 5 years. So there are two types of bonds. In that first type of bond, which is called a zero coupon bond, what can happen is, if a company is issuing a bond and promises to pay 10 lakhs after 5 years, so here there is no coupon. What is a coupon? Coupon means annual payments that you receive from a bond. Okay, so if there is a zero coupon bond, you will not receive any annual interest from the bond, but at the end of the period you will get 10 lakh. Then how will it be beneficial? You will not have to pay 10 lakhs for the bond, rather you will be paying a much less amount, say 8 lakh or 9 lakh, and you will get capital appreciation of the bond. The second type of bonds are called coupon bonds, in which you will get both regular interest payment, okay, and also you will get the principal at the time of maturity. So this coupon bond will be issued at rupees 10 lakh only, which means you will be paying 10 lakhs to the issuer, but at every fixed interval of times, generally annually, you will receive interest payments, and these interest payments are also called coupons. Now after the end of the period, which is called the maturity period, you will get the principal amount as well. Okay, so bonds are of two types. First is a zero coupon bond, which are issued at a lesser than face price, and you will get the face value at the time of maturity. The second type of bonds are coupon bonds, in which you will receive both annual coupon payments as well as principal at the time of maturity. Okay, so bond is simply a type of promissory note in which the issuer promises to pay a fixed amount and in some cases interest. Okay, fine. Now when I talk about the international financial market, the bonds are of various types. Okay, now mainly there are three types of bonds in the international financial market. The first is called a foreign bond. Okay, now what is the foreign bond? These, I'll start by giving an example. Suppose there is an Indian company, okay, and it issues bond in Japan. There is an Indian company and it is issuing bond in Japan, and that too in the Japanese yen. Okay, so a company is issuing bonds in a foreign country and the bonds are denominated in a foreign currency. Okay, such bonds are called foreign bonds. Okay, so they have to follow rules and regulations of Japan. Okay, clear? So the first type of international bond is called a foreign bond. These are the bonds which are issued in a foreign currency and are denominated in the foreign currency itself. Okay, and they are subject to the regulations which are currently prevailing in the country where they are issued. Okay, the second type of bonds are called euro bonds. Now again example, suppose there is an Indian company which issues bonds in US, but the bonds are issued in INR. Okay, so such bonds are called euro bonds. So when bonds are issued in a foreign country but are denominated in a currency other than the currency of the foreign country, then it is called a euro bond. Okay, and third type of bonds are called global bonds. Okay, now they are issued in a foreign currency but they can be placed in different countries and not necessary in a single country. Fine. So there are three types of international bonds. First is a foreign bond, second is a euro bond, and third is a global bond. Okay, see, international bonds are a very popular means of raising funds from the international market. So the investors, what they generally try to do is make these bonds attractive by adding various features. So accordingly they can give various types of names. Okay, they can call it a straight bond. So various features what can be added to the international bond to make them attractive is, for example, you can call it a floating rate bond. What is a floating rate bond? I told you sometimes the interest rate depends upon the market and changes according to market. So if the market interest rate increases, the interest rate on the bond will also increase, and if the market interest rate decreases, the interest rate on the bond will also decrease. So such bonds are called floating rate interest, and it is beneficial because it does not affect the price of the bond. Okay, the second type of bonds are called feature of bond is also called a convertible bond. See, suppose there is a company which has issued a bond initially, okay, but it also sometimes gives you option to convert this bond into equity at a later period of time. So such bonds which allow you to be converted into a fixed number of equity at a fixed price after a certain time period is called a convertible bond. The third feature I told you is a zero coupon bond. Now in a zero coupon bond you will not get any annual payments from the bond, but what you will get is a capital appreciation. So these bonds will be issued at a discounted price and can be redeemed at a par value. Okay. Now another option is called callable bonds. Now callable bonds are those which can be called off after a certain period of time. So those bonds which give an option of being cancelled after certain period of time are called callable bonds. So these are certain features which the issuer adds to the bonds to make them more attractive to the investors, because bonds are a major source of borrowing for the international financial market. Okay, so in the next class I will be talking about the international equity market, and with that we will be coming to an end with the various segments of the international financial market. So after that, in unit 3 we will be left with the various types of financial derivative options which I will be explaining you in detail. Thank you.